In this video, you'll get a framework for bond investing that most investors overlook. The problem is many people only think about interest rates, while the real danger comes from three other risks: credit, inflation, and liquidity. If you ignore them, your returns can quietly shrink or vanish. We'll analyze these risks, design a strategy around them, develop safeguards, implement trades, and evaluate results. Step by step, you'll see how to protect your income and strengthen your portfolio. To start, let's look at why bond prices and yields constantly push against each other. But first, this video is for informational purposes only and is not financial advice. I'm not a licensed financial advisor. You should do your own research and consult with a qualified professional before making any financial decisions. Hey, welcome to the Trading and Investing Hub. I'm Alex, and today we're talking about how to master bond investing. Imagine you lend $1,000 to a friend at 5% interest for 10 years. At first, it looks like a solid deal. $50 every year in interest, plus your $1,000 back at the end. But a year later, new loans are being offered at 7%. Anyone considering buying your existing loan now has to ask, why accept 5% when the market offers 7% for the same kind of promise? This tension explains the core truth of bonds. Prices and yields move against each other. To follow how this works in practice, let's ground the terms. Every bond is issued with a par value, usually $1,000. That's what you'll get back at maturity if the bond issuer doesn't default. Bonds also come with a coupon rate, which is simply the annual interest payment based on that par value. A 5% coupon means $50 per year. The part that confuses beginners is yield. Yield is your actual return based on what you pay today in the market, and it changes as prices move. That difference between coupon and yield is where the tension begins to show. When market interest rates rise, newly issued bonds offer higher returns, making older bonds with lower coupons less attractive. To compete, the price of those older bonds falls until their yield, meaning the effective return for a new buyer, lines up with current rates. When rates fall, the opposite happens. Old bonds with higher coupons look more appealing, so their prices rise. The direction of the price change depends on the rate environment, and the size of the change depends on time left to maturity. Bonds with more years until repayment are more sensitive to interest rate moves. In finance, that sensitivity is measured by a concept called duration. Duration tells you how much a bond's price is likely to move when interest rates shift by 1 percentage point. It helps to picture this with a simple comparison. Think of your annual coupon like a fixed salary. If you're earning $50,000 while everyone else is too, your income looks fine. But if salaries in the market jump to $60,000 while yours stays locked at $50,000, your income suddenly feels less attractive. That's exactly how a $50 coupon looks when new bonds pay $70. The coupon itself hasn't changed, but its value is all about what the market is offering now. This is why investors face two scenarios. If you buy a bond paying 5% and decide to hold it until maturity, you'll still receive the same coupons each year and get your $1,000 back at the end, assuming no default. But if you need to sell before maturity after rates have risen, the market price of that bond will be lower because buyers demand a yield that matches current conditions. Whether you're harmed by rising rates depends less on the bond itself and more on your decision to hold or sell. At this point, two closely related terms usually cause confusion: current yield and yield to maturity. Current yield is the coupon divided by the bond's market price today. It's a snapshot of how much annual income you're earning for every dollar you put in at this moment. Yield to maturity, often abbreviated YTM, goes further. It's the total expected return if you hold the bond until it matures, including all coupon payments and any difference between what you paid and what you'll receive at maturity. Put simply, current yield looks at short-term income, while yield to maturity measures long-term return under the assumption you keep collecting and reinvesting your payments until the end. The constant push and pull between bond prices and yields doesn't just create day-to-day market noise. It's the foundation for understanding every other bond risk you'll face. Price swings don't just reflect changing investor moods. They shape your real returns and dictate how credit quality, inflation pressure, and liquidity risk will affect you in practice. And it leads to a critical question. What happens when you collect every coupon payment on time, yet still discover that your bond left you poorer in real terms? That quiet threat is the next risk you need to understand. Inflation risk is often called the silent killer of bond investing because it quietly reduces the real value of every dollar you receive. Your bond may pay every coupon on time and return its principal at maturity, but if prices for goods and services rise faster than your bond's yield, your purchasing power is shrinking. That's the heart of inflation risk. It measures not whether you get paid, but whether what you're paid still matters in real-world terms. Imagine you buy a bond yielding 3%. On paper, that looks like a clean return. But if inflation runs at 4%, your real return isn't plus 3%. It's actually negative 1%. Each year, your money stretches a little less, and over time, those small losses compound into a meaningful erosion of wealth. The statement balance looks fine, but your living costs show a different story. To address this, the US government offers a tool called Treasury Inflation Protected Securities, or TIPS. The mechanism is straightforward once you strip away the jargon. TIPS adjust their principal value using changes in the Consumer Price Index, CPI. Interest payments are then calculated on that inflation-adjusted principal. In other words, as consumer prices rise, both your future coupon payments and your final repayment amount rise along with them. This helps maintain purchasing power, at least as measured by the CPI. That doesn't make TIPS a guaranteed win. They only aim to keep pace with reported inflation, which might not reflect every household's actual expenses. And in periods of low inflation, regular treasuries often pay higher nominal coupons than TIPS, which means traditional bonds can outperform in calmer environments. The practical point is that TIPS are a valuable protection tool, but not an all-weather replacement for other bonds. History shows just how damaging inflation can be when ignored. During the 1970s, US inflation surged into double digits. Long-term bondholders locked into 6% or 7% coupons saw those safe payments devoured by price increases of 10% or more. On paper, they collected income, but in reality, their wealth slipped away. That decade remains a cautionary tale. Fixed coupons can quietly become ineffective when inflation accelerates, no matter how safe the issuer appears. A common misunderstanding is that bigger coupons solve the problem. Yes, an 8% bond gives more dollars than a 3% bond, but if inflation hits 10%, even that 8% leaves you falling behind. Returns must always be compared to the environment. What matters is real yield, your nominal yield minus the inflation rate. Positive real yields grow wealth over time. Negative real yields erode it. This is the metric to watch, not just the size of the coupon check. So, how do you defend yourself? A quick rule of thumb is this. If preserving purchasing power is important, consider either adding TIPS or holding shorter maturity bonds. Short maturities give you the flexibility to reinvest at higher rates if inflation and interest rates climb. Many investors use a mix, blending TIPS for inflation adjustment with short-dated treasuries or high-quality corporates for flexibility. By laddering maturities, you avoid being trapped in low-yield, long-term bonds that might lose value when inflation rises sharply. The real lesson here is that inflation risk doesn't shout, it accumulates quietly, like rust spreading over time. Unlike a sudden default or market crash, you might not notice the damage until years later, when your steady coupons no longer cover the same basket of essentials. That's why planning for inflation is as important as earning the coupon itself. Protecting against it keeps your income meaningful in real terms, not just impressive on paper. Up to this point, we've looked at risks that reduce the value of payments you know you'll receive. But the next challenge is more direct. What happens when the borrower itself struggles to make those promised payments in the first place? Sometimes, the biggest threat to bondholders isn't inflation or interest rates, but the risk that the issuer simply fails to pay at all. This is known as credit risk. It's the possibility that a company or government either skips an interest payment or cannot return your principal at maturity. Unlike temporary price changes, a true default can mean permanent loss of your money. Here's the core idea. When you buy a bond, you're making a loan. The ongoing coupon payments and the repayment of your principal depend on the issuer's financial health. If that issuer weakens, your income is suddenly at risk. A missed coupon is a warning sign, while outright default can erase most, sometimes all, of what you invested. This makes credit risk one of the most direct and damaging risks in the bond world. Not all issuers carry the same likelihood of default, and this is where ratings matter. Investment-grade bonds graded AAA down through BBB are considered relatively safe, with historically low default rates. Bonds rated BB or lower fall into the high yield, or junk, category. These issuers are less financially stable, so they must lure investors with higher coupons. That higher income looks attractive, but it's payment for shouldering much higher risk. In plain words, the bigger the yield, the bigger the chance of failure. To give investors a reference point, rating agencies such as Moody's, S&P, and Fitch assign letter grades. Think of these ratings as shorthand risk signals. AAA means extremely strong, BBB hovers on the lower edge of investment grade safety, and anything below that heads into speculative territory. A D rating, of course, means default has already happened. These ratings don't guarantee outcomes, but they help you compare bonds at a glance. History proves that trusting high coupons without thinking about creditworthiness can be costly. During market stress, defaults rise fast, especially among speculative issuers. Recessions, industry downturns, and financial panics have all shown that bonds thought to be safe enough can collapse in value if the borrower's balance sheet cracks. Investors who chased the biggest yields often found their promised income transformed into deep losses. There's also another important signal you can watch even more closely than ratings: credit spreads. A spread is the extra yield a corporate bond pays over a US Treasury bond of the same maturity. Treasuries are considered free of default risk, so any difference reflects how much compensation investors demand for taking on credit risk. Wider spreads mean the market sees danger ahead. Tighter spreads mean investors are comfortable with risk levels. Put simply, spreads are like the heartbeat of credit markets. They speed up when conditions get shaky. Credit spreads were a major alarm during the 2008 financial crisis and again in the early months of the 2020 pandemic. In both cases, spreads widened sharply, clear evidence that investors doubted many companies' ability to keep paying their debts. For investors paying attention, these shifts served as early warning signs long before defaults actually surged. The challenge with credit risk is its timing. Weak issuers may appear stable during good times, managing to refinance and keep paying. But when the economy slows, those same issuers are exposed quickly. This clustering effect, where many defaults arrive at once, can leave portfolios of high-yield bonds badly damaged when stability matters most. That's why the key defense isn't prediction, but preparation. So what's the practical takeaway? Start with a simple 3-step checklist. First, always check the bond's credit rating to see where it falls on the scale of safety versus speculation. Second, monitor the spread between comparable corporate bonds and treasuries. Wider spreads should make you cautious. Third, diversify across issuers and sectors so a single default doesn't dominate your outcome. Taken together, these steps create a straightforward, reliable defense against the most damaging side of bond investing. Credit risk is unavoidable, but it is manageable. By combining ratings, spreads, and diversification, you can reduce the odds of suffering large permanent losses. Skip these checks and even attractive yields may come with hidden dangers. And while defaults strike directly, there's another trap investors run into that's less obvious: the difficulty of selling a bond when you actually need the cash. That challenge is where we turn next. Sometimes the danger isn't about whether a bond will pay, but whether you can actually get out of it when you need the cash. This is called liquidity risk. It means the price you must accept to sell quickly. You might be forced to take a much lower number than you expected, not because the issuer is failing, but because the market for that bond is thin. Think of it like leaving a concert. US Treasuries are like having dozens of wide, well-marked exits, easy to move in or out at almost any time. A small corporate or municipal bond can feel more like a single narrow door. When the crowd heads out all at once, things jam up. You can wait or push through, but either way, you'll feel the cost. That's what liquidity traps look like in practice. Your options disappear, and your flexibility is gone right when you need it most. One reason many investors underestimate this is they assume bonds trade like stocks. Stocks sit on centralized exchanges with thousands of visible buyers and sellers setting prices openly. Bonds are different. Most trading happens over the counter or OTC. That means you rely on dealers to make the market. Fewer visible quotes and fewer active participants mean bond prices can swing much more when demand disappears. In calm times, this doesn't matter much. In stress conditions, the difference between what you want for your bond and what someone is willing to pay can widen sharply. At the liquid end of the spectrum sit treasuries, which are among the most heavily traded securities in the world. Their constant tight pricing reflects a deep demand. Shift down to lower-rated corporate issuers or smaller municipalities, and suddenly trading is rare. These bonds might only change hands once or twice a week, or less. That lack of activity leaves you exposed to wider bid-ask spreads. Here's a simplified example. If a bond's fair value is $1,000, liquid markets might show buyers at $999, sellers at $1,001, a tiny difference. A thinly traded bond, though, may show buyers stepping back to $950 while sellers still hope for $1,000. To exit quickly, you're likely stuck selling closer to $950, swallowing $50 in hidden costs just for the chance to get out. Market panics make this even worse. In March 2020, for example, the sudden rush for cash caused even typically stable corners of the bond market to seize. Bid-ask spreads blew out. Buyers disappeared from many corporate bonds. And bond ETFs, which are praised for intraday tradability, started trading at steep discounts to the value of the bonds they held. That snapshot showed liquidity risk isn't just a problem for small or obscure issuers. It can ripple through nearly every product, even pooled ones, when conditions turn stressful. Liquidity is also dynamic. A bond that feels easy to sell today might not be when panic strikes. Credit ratings, issue size, and simple investor demand all affect how much liquidity you really have. Bond funds and ETFs reduce some risk by spreading portfolios across hundreds of issues. But as 2020 showed, they can't eliminate the problem entirely. You still remain tethered to the liquidity of the underlying bonds inside those portfolios. For investors, the lesson is less about eliminating liquidity risk. It cannot be fully avoided. and more about planning realistically for it. If flexibility matters, bias your allocations toward treasuries, major corporates, or broad bond ETFs. These give you the best odds of accessing cash without a big price penalty. On the other hand, if you want the higher yield offered by thinner, less active markets, keep your positions smaller and accept that selling in a hurry might cost you. Liquidity risk won't show up in your coupon rate or marketing brochure. It only appears when you try to exit and discover how little other buyers are really willing to pay. That's why it pays to think about this up front. Decide in advance whether the yield you're chasing is worth the possible haircut on the way out. Once you know that trade-off, you can begin shaping a bond approach that not only avoids pitfalls, but actively balances every risk you now understand. And that sets the stage for a full strategy, one you can design, implement, and evaluate with confidence. Designing a resilient bond strategy starts with turning risks into a structured plan. Instead of chasing yield or reacting to short-term headlines, the foundation is a clear process. One simple model that works well here is ADDIE. Analyze, design, develop, implement, and evaluate. It's a step-by-step framework used in project planning, and it fits bond investing because building a durable portfolio is more of a long-term project than a one-off bet. The first step is analyze. Begin with yourself before you look at the market. Ask a single question. Why are you holding bonds? Is it for steady income, for protecting capital, or for diversification against stock volatility? The answer determines everything else. For example, if you're saving for a near-term goal, like a home purchase, short-term treasuries may suit you best because you can't afford price swings. If you're investing for retirement decades away, you may tolerate more credit or inflation risk in exchange for higher yield. Without a clear purpose, every later choice risks being misaligned. Next comes design. Here the task is to match your personal risk tolerance to the three major bond risks: credit, inflation, and liquidity. The key question: which of these risks are non-negotiable for you? If you can't stomach the thought of a default, filter out junk bonds and stick with government issues or strong investment-grade corporates. If inflation concerns you, add some TIPS, which adjust their principal for changes in consumer prices. And if you might need to sell before maturity, focus on highly liquid options like treasuries or broad bond ETFs. The design step creates a simple risk blueprint. Decide what you will accept and what you won't. The third step is develop. This is where you turn the blueprint into an actual portfolio. The primary action here is build safeguards by diversifying. Include treasuries for safety, corporates for yield, municipals for tax benefits, and TIPS for inflation protection. Spread your holdings across issuers and sectors so a single weak borrower doesn't derail your returns. Then diversify across time by laddering maturities. Constructing a ladder means buying bonds that mature at different intervals, say 1, 3, 5, and 10 years. This way, some bonds are always nearing maturity, giving you cash to reinvest without locking your entire portfolio into one interest rate environment. Development is about assembling these moving parts into a mix that works under different conditions. After that comes implement. This is the actual buying step. Here, your immediate question is, will you use individual bonds or funds? For small accounts, ETFs or mutual funds give instant diversification, broad exposure, and easier trading. The trade-off is that you don't control the exact maturity dates. With individual bonds, you can match maturity to your needs. A 3-year bond for a tuition payment, a 10-year for longer goals, but you also face higher transaction costs and lower liquidity in many cases. Choosing between funds and individual issues isn't about right or wrong. It's about which trade-offs fit your situation. Implementing turns your design into real investments working in your account. The last step is evaluate, arguably the most overlooked part of bond strategy. Once you own bonds, you must monitor them. The key action: schedule a check every 6 to 12 months, or sooner if there's a major market move. At each review, look at 3 things. First, duration. This measures how sensitive your portfolio is to interest rate changes. Higher duration means greater price risk when rates rise. Second, your credit mix, the proportion of investment-grade bonds compared to high yield. This shows your true exposure to default risk. Third, your yield after inflation. This reveals if your returns are growing your purchasing power or shrinking it. If conditions shift, adjust gradually. Add TIPS during inflation spikes, rotate to safer bonds when spreads signal stress, or shorten maturities if rates may rise. Evaluation isn't about constant trading, it's about steady realignment so your portfolio keeps serving your actual goals. By following ADDIE, analyze, design, develop, implement, evaluate, you impose structure on bond investing. Each step gives you a concrete action and checkpoint, so you're not guessing, you're managing. The result is a portfolio that weaves risk protection into income generation, adapts as conditions change, and keeps your financial plan on track. And here's the larger lesson. The strategy isn't about squeezing every last drop of yield. It's about managing the risks that quietly erode returns. Those who master that balance gain the real advantage in bond investing. Now that you've seen how the different risks play out, the final step is turning knowledge into action. Success in bonds isn't about predicting headlines. It starts with a simple checklist you can run on your own holdings today. First, check duration. Are you comfortable with the price move if rates rise? Second, check real yield. Is your income actually beating inflation? Third, check liquidity. Could you sell quickly without taking a heavy discount? These 3 quick tests give you a clear snapshot of where your portfolio might be vulnerable. I'd like to hear from you. Drop a comment below and tell me which of these 3 risks concerns you the most. Remember, bond investing isn't about chasing the biggest coupon. It's about matching risk to your goals and managing the hidden threats we've covered. If you run those 3 checks today, you'll know exactly which part of your bond plan needs adjusting.